kind of going back to that question of where's the money going? They're
Mhm.
making all this money. Where's it going? They may be spending a lot to maintain the business. Then that kind of goes back to what Andrew was talking about with the relationship between CapEx and depreciation. And
Because I have done it many times where I did not get the big picture overview, dove super heavy in the weeds, and then was like, wow, I just wasted hours on this when I could have caught it from.
the metric that I have kind of grown to really like, and it's called return on incremental invested capital.
That's the question I want to know too. Pretty early in the process of looking at a stock for the first time, because
All right, folks, welcome to Investing for Beginners podcast. Today we have episode 381. Today we're going to do a bird's eye view of Union Pacific Corporation. This is a railroad. We got this great question from Dre on Spotify a while back, and we thought today would be a good day to kind of uncover what we see in Union Pacific. So maybe let's start with like a air quote company overview. Like, what do they do?
yeah, good question. I have no idea. When I think of a company like this, the first thing that comes to mind is just things I've heard anecdotally through podcasts. And so I don't know if Buffett has shares in Union Pacific or if it's one of their competitors.
Yeah, it's one of their competitors to be BNSF, which they own.
Okay. But I do remember a Berkshire expert talking about the railroads just as a general, the industry.
Right.
And I remember one of the attractive features of that particular investment for Buffett was, obviously I don't know what I'm talking about, but they basically went from a single stack to a double stack. And in my mind, that's like, oh, you just doubled the efficiency or capacity or whatever it is. So I know at that time when he had bought it, that's what he found attractive in it. And so that automatically frames the way I look at this stock is like, okay, can I put that into a growth estimate, and does that make it an opportunity? And so whenever I'm looking at a new stock, I always try to think about what are the various things I've heard and how is that going to affect how I look at the stock. So those are my first thoughts. Like what were your first thoughts at Union Pacific, and do you happen by chance to know what they do? Because that would be awesome.
I can read the company overview, which is taken directly from the 10K, which is here on FinChat, and I'll just kind of read a brief synopsis here. So the company offers transportation services for grain and grain products, fertilizers, food and refrigerator products, coal and renewables for grain processors, animal feeders, ethanol producers, and other agricultural uses, as well as petroleum, liquid petroleum gases, and other fine stuff. So basically, they are an extension. Probably the other major way that we move products across the country, like trucking industry. And so to my understanding, BNSF, which is the one that Berkshire owns, Union Pacific, and I think there's a third one. I know enough to be ignorant. And so I think those three are there's the three main competitors. And depending on where you are in the United States, this is their territory, this is their territory, this is their territory. So that's basically what I know. And then they obviously charge rates for carrying said products from Los Angeles to New York, for example.
Yeah. And I've done some work in trucking, and I remember that being a thing. There's different rates depending, like you said, distance, and then obviously weight too, or even type of container. So that can all play a role.
Yeah. So there's, and that's the main way that these companies make some moolah. Do we want to talk about maybe some overview of some deets like market cap and some of that fun stuff?
Yeah, I'll throw a random one out there. They're headquartered in Omaha, Nebraska, so I find that kind of cool.
Right in the middle of the country.
Tools are your friend if you are trying to analyze a company for the first time. You want as many big picture overviews you can get before you dive into the weeds, because I have done it many times where I did not get the big picture overview, dove super heavy in the weeds, and then was like, wow, I just wasted hours on this when I could have caught it from looking at the big picture instead. Whether that's too much debt, whether it's the possible warts are endless, but you just won't know until you try to take that big picture. So when I plug big picture into my automated spreadsheet, the first thing I notice that stands out to me is over the last 10 years, their they've grown sales about 1.5% per year. Over the last 4 years, it's around 2.5%. So getting better, but this is not a knock your socks off revenue growth to the moon type of business. The first impression I get is okay, it's a lower revenue growth story. So what else is in the picture? And so I'll hand it over to you to see like what else do you see?
Let's start with the market cap. So it's a little over 140 billion in market cap. So not a small company, not monstrously huge, but not small. The revenue, it generated 24.3 billion in revenue last year. So those are big boy numbers. They're maybe not Walmart or Amazon kind of numbers, but they're in the same range as a Visa or MasterCard as far as what they produce revenue wise. You mentioned revenue growth. It's been fairly slow. So according to FinChat, for 3 years, we have 4.6%. 5 years, 1.7%, and 10 years, 0.35%. So as you said, not a to the moon kind of company. All their metrics are pretty decent. ROE, ROIC, things of that nature. Their margins are way better than I would have expected, frankly. It has gross margins of 55%, operating income of 39%, and net income of 27%. Those are on the margin levels of like a Microsoft or a Google. Which kind of surprised me. I think of a railroad as, very thin margins, low margin businesses, and that does not appear to be the case. So that is something that kind of stuck out to me as a potential upside of something like this.
You mentioned the ROIC, and I've been using a tool called New Constructs. They have an institutional membership, and they found their ROIC to be second quintile, and so that's the second best quintile, obviously. So pretty good ROIC. And to your point, it's not, if I imagine a railroad, I think of something that's going to cost a lot of money, but the ROIC suggests not. And then also they've been a shared deleter. They've deleted around 4% a year in shares outstanding. So a nice bump from the fact that there appears to be, from first glance, you're like, oh, okay, shares are down. They're probably in the capital return stage of the business. And so there might be extra return that you don't get just from top line only, revenue growth only. Yeah.
Right. Yeah, exactly. And kind of to that point, dividends seem to be, decent. Like the growth has been between 8% and 11% over the last 10 years. It's a yield of 2.1%, which isn't awesome, but it's not horrible. And they're paying out 48%, which means there's plenty of room if they want to grow the dividend more, or if they have a downturn, they have the flexibility to continue paying the dividend. So that's a bonus. So I think if you add the dividend yield and the return that you get on these shares, cannibal part of their business, that's a 4 to 6% return right there, just on those two things. So that's not horrible.
No, certainly isn't. Those type of things, looking at the margins, looking at the capital efficiency, looking at what they're doing, are they in the capital return stage or are they in the reinvestment stage? How do those metrics frame how you would analyze a business like this?
Ooh, that's a good question. If I'm looking at a company like this, there's like, I guess, 3 legs I'm looking at. One would be revenue growth. The other would be profitability, so the margins. And then the third would be reinvestment opportunities. And when you look at the revenue growth, it's not great. It's, not ideal. You look at the margins and like, holy moly, this is a really profitable business. That's awesome, because that all flows to free cash flow. And so you would think that they would have like oodles of reinvestment opportunities, some way, shape, or form. And then you look at the returns that like ROIC, ROE, and they're not horrible, but they're not awesome either. And like ROIC is 10, 11%, which isn't awful depending on what their cost of capital is, but it's also not stellar. It doesn't really match what they're doing with their profit margins. And So when I look at those kind of three legs of the business, those would be high on the list of questions I would want to get answers to. Like, why is this a really profitable business that doesn't have much revenue, and it doesn't look like they're returning, like their efficiency and returns on investments doesn't seem to be all that outstanding. So where's the disconnect? That's what I would want to find out before I would buy this company. I have to answer those questions.
And that's something we ended up figuring the answer out to in a
Mhm.
relatively short amount of time, since we had two brains working on it instead of
Right.
one.
Right. Right. Maybe like if you're looking at this so far, what kind of stands out to you?
Everything we've said, and then in my spreadsheet, it also calculates a quick DCF,
Oh,
just taking like
excuse
historical.
me.
Sorry, didn't mean to offend. Um, it takes like a historical revenue growth. So if you plug in their 1.3% over a 10-year average, and then you take, free cash flow, the stock looks expensive. So with all of that in mind, I I automatically stereotype it, put it in the bucket of, okay, it's not going to be a huge reinvestment story. Probably, like you said, the revenue is so low. So the ceiling is probably lower, but then also if they're buying back a lot of stock and you're getting a nice dividend yield, the floor is probably higher, as long as the valuation or the price is not too high.
Mhm.
And you can debate whether that's the case or not, but what's nice about a company that's a share cannibal, like you mentioned, is if they have that track record of continuing to delete a lot of shares and you're getting return from that, as long as the valuation's not moving a lot, you should see that continue. That trend should continue. So that's possibly in play for this company. And that's a question I want to know too, pretty early in the process of looking at a stock for the first time, because if the valuation is not anywhere close to what would be acceptable to me, then digging further is probably a waste of time, unless I'm
Mhm.
trying to learn it just for, my base of knowledge or something. So that's why, all of the things we looked at are good. And then I also like to tag on valuation.
Mhm. Yeah, that's a great part of the process. If I was looking at this company and I wanted to go a little bit deeper, I think the first thing I would probably do is look at other railroads in the industry,
Yeah.
not just here in the United States, but also in Canada, which is, I know, they have a big railroad system there as well. I would want to know, okay, are these revenue growth numbers, are these typical for the industry, or is this an outlier for Union Pacific? Uh, it obviously plays a strong part in our economy. It has an important place in how we do what we do in the United States, for example. But if you can't, I mean, I'm not saying it's a hard no out of the gate because the revenues are so low, but I would want to know what do I expect? Like, the market has given it a little over 5% return over the last 5 years. So not horrible, but not awesome either. It's certainly lagging the S&P 500 by a lot. And so that would be, I guess, a concern. But to your point about the valuation, like anything that we've talked about so far, would any of these automatically disqualify it for you?
Automatically, I honestly, I would probably hard pass on it, but that's only because it's taking me a long time to learn this, but I am in the accumulation phase of my
Mhm.
investment journey. And so I need top line growth
Mhm.
to achieve what I'm trying to achieve, which is team up with businesses and hold them for the long term. So
Right.
for me personally, I'm out.
Mhm.
But if there are other investors with other um, time horizons or goals they want to achieve with their investments, then it
Mhm.
could still be attractive. But it's still
Right.
fun to look at for sure.
Yeah. Oh, absolutely, it is. It could easily fit into. I could see it fitting into a portfolio of somebody that is getting closer to retirement and
Mhm.
is maybe wanting to move out of, let's say, Meta into something that's a little safer, but still is going to earn better return than they would get in a money market account, for example. I think something like this would probably fit the bill quite nicely, because it's a fairly safe, stable business that is unlikely to go to zero anytime soon.
Right.
Digging a little deeper, then maybe let's talk a little bit about ROIC. So we kind of mentioned that the returns are okay, but what have you found? You kind of did a little more digging on new constructs, and what did you kind of find there?
Yeah. So back to what you were saying is very peculiar, like that they're such a free cash flow generating high margin business, yet you're not seeing what you would think would be high growth from a very capital efficient business. So the first thing I did was pull up on quickfs.net. What's the cash flow statement look like, and what does it look like for a long time? Because to Dave's point, if they're generating a lot of cash flow, where is it going? And so the cash flow statement can be a great place to look at that. And we both looked at that at the same time. And I was like, okay, dividends are pretty much the same. Buybacks are pretty similar. Like nothing big is jumping out. But one thing that I learned from one of the blog posts you did was it the Bruce Greenwald's book on maintenance capex? Was that the one? Yeah.
Yep.
This idea that if you compare capital expenditures and depreciation and amortization, you can sometimes get a picture of growth capex versus maintenance capex. There's a lot of accounting. Let's try to bring it back down to earth. Is if you think about like what a railroad would do, they're probably having to maintain the rails themselves, maybe the cars that are on the rails, a lot of machinery and vehicles that could be required for that. And so in the case of Union Pacific, capital expenditures are much higher than depreciation and amortization. So that my first thought is, okay, maybe they're reinvesting for growth. But then because QuickFS shows us over 10 years, it's actually always their property plant or their capital expenditures are always about $2 billion higher than their depreciation, which is not, I'm not saying it's not out of the ordinary, but it's also not a majority of the time, as far as I've seen. And so that starts to clue me into, okay, ROIC can be a good metric. They can have a good ROIC, but that doesn't always lead to a company having growth. So maybe you can talk about that, because there's several ways that a high ROIC company could still not grow a lot.
Yeah. There's a metric that I have kind of grown to really like, and it's called return on incremental invested capital. And basically what it does is it measures the growth of earnings, for example, or operating income, and you compare that to the growth of invested capital. So the money that a company is putting out to invest in the business. And if you measure the changes in those and then measure those, as a ratio, that will give you a percentage of how well they're investing their incremental growth in capital. And one of the things that was interesting about Union Pacific, when Andrew looked it up on New Constructs, it looks like generally the invested capital for the business is fairly flat. It hasn't really grown that much, like maybe 4 or 5%. If you look at that compared to the growth in the earnings of the business, they don't really, I mean, it's okay, but it's not great. And so you really ideally want a higher ROIC, or return on incremental invested capital, than you do on return on capital, because that really means that the company is really actually putting it to work. It's a great way to measure how you do that. Because if you look at the ROIC of Union Pacific over the last 10 years on FinChat, in 2014 it's 11.1%, in the last 12 months it's 11.1%. So exactly the same. And it's not growing. And in and of itself, that's not horrible. But then when you compare it to the other metric that I was just talking about, you see that they're not really effectively using the earnings that they're generating to buy assets to reinvest in the business. And so that leads to a flatness that you'll see in the ROIC and the returns. And, kind of going back to that question of where's the money going? They're making all this money. Where's it going? And so it's not really going into effectively growing the business. They may be spending a lot to maintain the business. Then that kind of goes back to what Andrew was talking about with the relationship between CapEx and depreciation. And again, to bring this back to normal words, it really means that the money the company is spending is really more to maintain the business than it is to grow the business. And that's what I can kind of deduce from looking at the financial statements is, you and I can spend $20 to get better shoes, which makes us a better runner, which puts us in better shape, which improves our health, which means we can spend less money on health insurance or, other health related problems because we're in better shape. Union Pacific is buying maybe not as great a tennis shoes, and they're not working out as much, and they're just doing enough so their weight doesn't go up, but their cardiovascular doesn't improve much either. And so to me, that's kind of what I'm taking away from kind of what we're talking about here.
Yeah. If you want some unsolicited advice, here you go, world. Like,
right.
Get some Brooks shoes. Run smarter. Come on.
Right.
To help you grow as an investor, I'd say probably our free ebook and email series at stockmarketpdf.com. I do like that analogy a lot. And what I find fun about this whole experience, because I'm weird, is that there are different ways to get to the same conclusion. And hopefully we've proven on the show that there are different metrics that lead you down a similar path. Like that question that you framed at the very beginning of the show, where is the disconnect? With time and with experience and using enough formulas or metrics or tools, you can find the answer. And honestly, like, you could do it the way we did it, which to me, I always go like these roundabout ways. Something even as simple as looking at the free cash margin and comparing to the net margin and then the operating margin, that can sometimes tell you a similar story. So lots of different ways. And I don't have like a universal way to say every question for every company can be measured by looking at these 5 metrics. It's just kind of not how it works. But I think over time, the more you put the reps in, you can become better and start to identify situations like this.
Yeah, for sure. Let's say that you found some things that you found appealing after looking at the numbers. Like, where would you go next?
At that point, I like your idea of looking at the competitors also. From there, I would either read the 10K of Union Pacific or one of their competitors. If I was in their numbers and I was like, "Ooh, I like these numbers better," I'd probably read that annual report and then start to, like, I have to have like a whole process. Like, my iPad needs to be charged. My pad of my notepad needs to be right next to me. I have to have a pen that's not like about to die, because that would drive me nuts, because I need to take good notes. So you have to prepare for it. And that's why the metrics are important. So yeah, that's what I would do. I would start to go into that deep research at that point. And I think that's where a lot of the hard work is too, obviously.
Yeah, for sure.
What about you?
Well, I would do the exact same thing. I would, if I was looking at this company and I was like, I'm intrigued, I want to learn more about it. I would definitely read the 10K, and then I would definitely read competitors' 10Ks to get a sense of the industry. Because again, bottom line is, if I really find this interesting, I want to know why the revenue is the way it is. And if I discover that this is part of, it's normal, air quote, normal for the industry, then I don't maybe feel so bad about it. And then it would be maybe not bad, but it wouldn't be an automatic disqualifier at that point, because now like, okay, this is the way, this is kind of the nature of the beast, so to speak. And like, okay, kind of understand it. Like if you compare Costco to Walmart and you look at the margins, they're in the same ballpark. And so it's not a shock. If you look at Costco's margins and then you look at, something like Google's margins, you're going to be like, oh, that's awful. But it's a different business. You can't compare apples to oranges or bananas. So you gotta try to figure out what would work best. And I would definitely go to the 10K, and I would absolutely read more than just Union Pacific's. I would look at any of the other competitors, including BNSF, which is under the Berkshire umbrella.
Yeah, that's awesome. Final thoughts or any comments for our friend, the commenter, him or herself?
For me, Union Pacific would probably not fit where I am in my investing today. Depending on where I am in my journey, I think this could, as I mentioned earlier, this could be a nice place to park your money if you're closer to retirement. If you are 28 years old, I would probably say there are better opportunities out there for you to find. The railroads are an interesting space, and they're unquestionably important to our economy here in the United States as well as other parts of the world. And I think it's probably the same podcast we listened to. It was I think Patrick O'Shaughnessy had a guy that was kind of a railroad expert. And I remember after listening to him, I was all fired up. I'm like, I got to check into railroads. This is, sounds awesome. And then I started looking at some of the numbers. I was like, maybe this isn't quite my cup of tea, so to speak. It felt like after listening to him that everything was amazing. And then I started looking at them and they all felt a little overvalued for what they were offering.
Yes.
But, to me, depending on where I was in my journey, I think it would definitely be worthwhile to look into. And if it's just something that, fits your curiosity bug, I think it would be an interesting space to look into.
Yeah. Well, I love all that. I mean, fully endorse that entire message, and I have nothing to add. We hoped you enjoyed the show and the education. Feel free to write us, as always, newsletter at investingforbeginners.com. Connect, learn, and grow with Value Spotlight. Peace.